A crisis nobody budgeted for is squeezing homeowners from Los Angeles to Toronto to Tokyo this year. Mortgage payments are rising faster than salaries, and remorse is spreading through neighborhoods worldwide today. If you are shopping for a home, this guide may save your future self. You will learn practical strategies to avoid homebuyers' remorse and navigate today's housing affordability crisis. Stay with me for data, stories, and calm, step-by-step moves that protect your budget. Around the world, families face high mortgage payments and unpredictable rate changes, hurting monthly budgets dramatically. This video gives you a clear playbook to stress test affordability and avoid costly first-time buyer mistakes. We will cover fixed versus variable decisions, refinancing options, and practical mortgage payment strategies that really work. You will also learn negotiation tactics and red flags that warn of a housing market bubble. By the end, you will feel confident, prepared, and focused on long-term financial health today. Saifo and Lena found a dream townhouse, bid high, and celebrated with family that evening. 6 months later, their variable rate adjusted twice, lifting payments more than 1/3 instantly without warning. The new number crushed their budget, and every grocery run felt like a financial referendum. They were not alone, because rate hikes hit millions and reshaped homeownership dreams across continents this season. Their turnaround began with a sober audit, hard conversations, and a smarter mortgage structure negotiated with care. Rates rose quickly across many countries as central banks fought persistent inflation with aggressive monetary tightening recently. When policy rates rise, lenders reprice mortgages, especially variable and adjustable loans, lifting monthly mortgage payments significantly. Even fixed loans are affected when they renew, often at much higher rates than before. Insurance, property taxes, maintenance, and utilities also climbed, increasing the true cost of homeownership beyond the headline payment. Result: a mortgage affordability crisis where households spend unsustainably high income shares on housing obligations every month. Your mortgage is not just principal and interest because several silent costs grow steadily behind scenes. Property taxes can escalate, especially after reassessment, surprising owners with higher escrow needs and tighter cash flow unexpectedly. Home insurance premiums react to weather risks, repair costs, and regional claims trends, pushing annual bills higher yearly. Maintenance averages around 1 to 3% of property value annually, with older homes skewing higher usually. If you budget only the lender quote, you are walking into home loan repayment stress. Total monthly housing costs should fit conservative debt-to-income guidelines that withstand worst-case scenarios without panic. Build 3 tiers: base case, stress case, and severe case using realistic rate shocks and expenses. Base case uses today's quoted rate and typical taxes, insurance, and maintenance for your area now. Stress case adds 2 full percentage points to the rate and increases other costs modestly. Severe case adds 3 points, bakes in job uncertainty, and assumes delayed income growth for safety. Fixed-rate mortgages provide payment certainty, which protects sleep and facilitates long-term planning under inflation pressure. Variable or adjustable mortgages can save money initially, but transfer rate risk squarely onto your monthly budget. If you choose variable, set firm guardrails, including automatic prepayments and a rate trigger for refinancing decisively. Consider hybrid structures where an initial fixed period transitions to variable later, balancing stability with potential savings. The right choice depends on your cash buffer, income stability, and risk tolerance under plausible rate paths. They refinanced from fully variable to a shorter fixed term with prepayment privileges that reduced interest meaningfully. They automated bi-weekly accelerated payments, which effectively make 1 extra monthly payment each year without effort. They also built a sinking fund for maintenance, so repairs stopped colliding with lender drafts each month. Within 1 year, their balance fell faster, late fees vanished, and budgeting stress declined across the household noticeably. Their biggest win was clarity, because they knew exact numbers and planned life around them confidently moving forward. Part 1 is a values check to confirm why homeownership serves your actual life priorities today. Part 2 is a location audit comparing commute, schools, amenities, and resilience to climate risks carefully considered. Part 3 is a budget stress test with rate shocks and non-mortgage costs built in conservatively. Part 4 is a price discipline rule that caps offers regardless of bidding war pressure or emotions. Part 5 is a post-closing plan covering insurance, emergency reserves, and early principal prepayment scheduling commitments. Buying a house too soon before building a 6-month emergency fund for shocks makes budgets fragile. Confusing pre-approval limits with safe budgets causes people to overpay for a house without realizing risks. Ignoring inspection red flags that turn into expensive repairs can decimate your first 2 years quickly. Choosing variable rate loans without a backup plan invites monthly mortgage increase surprises and painful lifestyle cuts. Skipping neighborhood due diligence can trap you with hidden costs, noise, or weak resale demand later. Rapid price-to-income expansion, outpacing wage growth over several consecutive years, stresses affordability severely. Investor purchase share. Surging alongside falling rental yields can indicate speculative dynamics entering the market actively. Listings sitting longer while sellers resist price cuts may signal demand softness under higher financing costs. Appraisal gaps widening and frequent over-asking bids driven by fear indicate froth building without fundamentals today. Sharp mortgage delinquency upticks among recent buyers can foreshadow broader price pressure and credit tightening soon. Define a maximum all-in monthly number that survives your severe stress case and never cross it. Target homes priced below your maximum, so negotiations leave room for rate changes and surprise expenses. Use inspection contingencies, financing contingencies, and realistic timelines to keep leverage during a competitive offer situation. Negotiate seller credits for repairs or rate buy-downs that lower payments more than small price discounts effectively. Secure a rate lock when appropriate and calendar its expiry to avoid last-minute surprises at closing. Calculate the break-even horizon by comparing rent, after-tax mortgage costs, maintenance, and selling costs carefully considered. If you plan to move within 3 years, renting often beats buying under higher rates. If you have a longer horizon, buying can win, but only at a disciplined price. Run both paths through your base, stress, and severe cases before committing to either option thoughtfully. This is not about pride or fear because it is about resilience and freedom. Make accelerated biweekly payments to create an extra annual payment that shortens amortization significantly. Round up payments to the nearest meaningful increment, adding painless principal each month toward faster payoff. Apply windfalls to principal, especially tax refunds or bonuses, but keep emergency reserves untouched for safety. Set calendar reminders for annual mortgage reviews, insurance requotes, and property tax reassessments for savings opportunities. Track your debt-to-income ratio quarterly to ensure progress and spot drift before it becomes stress. Refinancing can reduce payments, change term length, or consolidate higher interest debts when numbers justify it. Calculate total costs, including legal fees, appraisal, and potential penalties, and divide by monthly savings carefully. If break-even exceeds your likely stay in the home, refinancing may not be prudent currently realistically. Consider a shorter term if cash flow allows, since shorter terms reduce interest cost and build equity faster. If rates decline substantially, evaluate fixed conversions from variable to lock-in stability without unnecessary delay. Homebuyer regrets often come from misaligned expectations, not only from dollars and cents miscalculations alone. Social pressure pushes people to stretch because friends are buying, and fear of missing out escalates. Counter with a personal policy. Money choices must match values, goals, and well-rested math consistently together. Replace status stories with resilience stories, where freedom from stress becomes the measure of success instead. You deserve a home that supports life, not a payment that steals your peace. 1. A 6-month emergency fund separate from down payment and closing costs is in place. 2. A conservative payment that survives severe stress testing with taxes, insurance, and maintenance fully included always. 3. A plan for early principal prepayment and calendar reminders is set before closing actually occurs. 4. An exit plan if you need to sell or rent the property quickly exists. 5. Sleep test passed because if you cannot sleep, the deal fails regardless of everything today. Start with market data, days on market, price cuts, and list-to-sale ratios in neighborhoods. Identify properties with stale listings or inspection issues where seller credits or concessions can create real value. Offer firm but friendly, anchoring below your cap, and justify with comparable sales and adjustment math clearly. Ask for credits that fund a temporary buy-down or closing costs, which improve monthly affordability materially quickly. If negotiations stall, walk away and remember that overpaying today compounds pain for many years. Create a sinking fund equal to at least 1% of property value per year. Automate transfers monthly so the account grows invisibly and prevents repair bills from wrecking cash flow. Schedule seasonal maintenance for roofs, gutters, heating, cooling, and drainage to prevent costly surprises later. Document appliance ages and expected lifespans, and budget replacements before failure, not after breakdowns during winter. Predictability is the antidote to anxiety, especially when rates and prices move unpredictably elsewhere around you. No one can time rates perfectly, and policy paths shift with inflation and growth surprises unpredictably. Plan for ranges, not points. A corridor where you remain solvent and calm across scenarios sensibly designed. If rates drop meaningfully, you will refi. If they rise, your fixed structure shields your budget. Build your plan to win across possibilities rather than betting everything on one exact interest outcome. This mindset transforms uncertainty from a threat into a set of manageable parameters for decisions. Confirm monthly payment in base, stress, and severe cases using conservative taxes and insurance assumptions. Ask about recent claims, repairs, permits, and warranties to gauge risk and future expense probability comprehensively considered. Measure noise, traffic, and flood risk, and check cellular service where you will actually work daily. Time the commute during peak periods and test parking, lighting, and safety impressions after sunset carefully. Note nearby development plans that might change traffic, views, or school zoning over your ownership timeline. It is the worst year to buy at any price, but a disciplined price works. Variable loans reset, fixed loans renew, and non-mortgage costs rose, increasing total housing costs very broadly. Crashes require forced selling, credit distress, and unemployment spikes. Watch local delinquency and inventory first. Stay under your cap, maintain reserves, consider shorter fixed terms, and prioritize early principal reduction consistently. Focus 6 months on debt reduction, income growth, and savings. Improve rates, insurance, and resilience meaningfully. Please subscribe, like, and comment. A wise purchase is patient, informed, and aligned with your goals, not anyone else's preferences. There is no shame in waiting, renting, or walking away when the numbers do not work. Courage in money is quiet discipline, not flashy risk, and that discipline compounds into freedom later. You can do this because thousands have done it by following calm, structured steps before you. Stress test payments with 3 rate scenarios and include taxes, insurance, and maintenance without exceptions whatsoever. Choose fixed for sleep and certainty, or variable with strict guardrails and automatic prepayments always engaged. Negotiate credits and contingencies. Never cross your monthly cap no matter how emotional the process becomes. Run rent versus buy math with honest time horizons and realistic moving plans, then choose deliberately accordingly. Automate maintenance, prepayments, and annual reviews, building resilience and confidence while markets shift around you. If this helped, share it with someone who needs calm financial guidance today, honestly. Your support helps more families avoid homebuyers' remorse and build stability, one smart decision at a time. Subscribe for deep dives on budgeting, mortgages, and wealth strategies that respect real lives and priorities now. Comment with your biggest question about mortgages, refinancing, or negotiations, and I will prioritize it next. Together we can navigate high mortgage payments and protect your long-term wealth amidst uncertainty with clarity. Thank you for being here and investing in your financial knowledge meaningfully at this time. This channel is about practical steps, clear numbers, and encouragement you can put to work immediately everywhere. You are not behind, you are building wisely, and your patience is an asset in markets today. I am proud of the thoughtful decisions you are making, even when they feel slow and boring. See you in the next video, where we continue building wealth with discipline, purpose, and peace together always.